The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and welcome to Investor Expo Show for March 25th. My name is Anna, and I'll be your host today. We're having a great lineup of 4 speakers for you: Michael Valtos, Stephen Cowitzel, Dan Passarelli, and Ala Peters. This session will be recorded and sent to your email. Please take a look at your GoToWebinar control panel. Into the questions box, you'll be able to ask any questions you want during the speaker.
Unmuted.
I would like to begin and bring to the show our first guest, Michael Valtos. Good morning, Michael.
Good morning, Anna. It's a nice Thursday afternoon in some places. It's about 10 o'clock here in Chicago. Let me get my screen up here. Okay, hopefully you can see everything okay. And the sound is good.
All is great. Thank you. You have 45 minutes.
Excellent. Thank you, Anna. Thanks, everybody, for taking the time out of your busy schedule today. You know, the markets are been pretty hectic week. Honestly, it seems like every week is a hectic week nowadays. And, you know, one of the things is, you know, when the market is at such high levels, the volatility is greater, the moves are greater. So what I want to talk about today is things, you know, that you should know about order flow. And really my goal today, you know, sort of what I wanted to tell you about order flow is how simple it is and easy it is to use order flow in your trading. Now, what attracted me to order flow years ago, and I'm talking about, you know, well over, 10, 15 years ago, was that I wanted to be able to see things in the market that other traders didn't. You know, I wanted to understand why a market moved when there was no reason for the movement. You know, sometimes, you know, especially nowadays, you know, electronic trading is very fast, very quick, and you see the markets just literally turn in a second, all right? And we may not know the reason why it turned, but if we understand what's happening in the order flow, we could say, oh, yeah, now it makes sense. I could see why the market turned here. So order flow is based on what's happening in the market right now. And why is that important? It's because you have to trade the present, not the past. And what benefits traders more is by analyzing what's happening right now in the market, because that's based on what's trading right now, right? You know, a lot of people like to talk about their fancy indicators, their moving average, etc. But all that stuff is based on price, which happened in the past, not necessarily what's happening right now. Now, for those of you that haven't got it yet, I'm going to show you how to get a copy of my book for free. It's called Trading Order Flow. It's a 150-page book. You're not going to get a hard copy. You're going to get a link to the digital download. But if you stay till the end, I'll show you how to get it. Now, for those of you that are new to who I am, my name is Michael Valtos, and I've got over 25 years professional trading experience. Now, when I say professional trading experience, I don't mean I traded my own account, you know, while I worked as, you know, in another industry. No, I was in the industry, in the futures industry. I started on the CME trading floor, literally as a runner. You know, that's as low as you can start. And I worked my way up from there. I spent about 2.5 years on the CME floor in the currency quadrant. Then I left the floor to work on the upstairs trading desk when electronic trading started taking off, because you know what? I thought that's where the future of the industry is going to be, and that's where I want to be. And that was back in the early 1990s. After Dean Witter, I joined EDF Man, the big English trading company. It's been around since the 1700s. Spent 2 years there on their global macro futures trading desk. Then I left Man to join Commerzbank, right, the big German bank. They opened an office in Chicago, and I was hired as a Eurex trader, right? I traded Bunds, Bobbles, Schatz, DAX, Euro stocks against all the U.S. products, right, against the S&Ps, against the 10-year notes, 5-year notes, etc. After Commerzbank, I then joined Cargill, right, the big U.S. commodity trading company, and it's, you know, either the largest privately held company, or I think some other company just overtook it, but it's, you know, they account for about 30% of the grain exports of the United States, about 25% of the meat exports, but they literally trade everything that's tradable. And I spent 4 years there. They sent me out to Singapore to set up a trading desk when the exchange in Singapore closed. And after Cargill, I joined JP Morgan. I spent 8 years at JP Morgan, vice president of futures trading, on the trading desk trading, not sitting in an office, looking at spreadsheets, coming out every once in a while to talk to the traders. No, I was the trader. I was on the trading desk. After JP Morgan, after I got married, after I had my first child, I realized, what, this is not what I want to do. I don't want to have a heart attack working, 12 hours a day, in a bank. So I left JP Morgan and, I knew how to trade. So I just figured I'll just trade for myself. And so I started writing my book on order flow, the book that you get at the end. And I was trading with the order flow already, but the software that was out there, I felt lacking. Okay. It was just, as I was writing my book, I realized there's all these little nuances of order flow that I said, you know what, I could take all that information, put it in a software rather than just having your normal, you know, footprint chart looking at the order flow. I said, let the computer highlight certain things to me, what's happening in the order flow to make my life easier. Okay. And the platform that it runs on is NinjaTrader 8. So really, it was a transformation for me, right? Because I wanted software that would help me in my analysis, make my analysis a lot easier, but at the same time, it didn't exist, right? There was just your normal order flow footprint chart. But I said, you know what? Let's make something better, right? Apple didn't invent the mobile phone, but they just took the existing technology that was out there for the phone and made it better, right? So you're going to realize there's more to just order flow than just delta, point of control, and imbalances. And again, the reason I just talk about that is because the charts that are using in this presentation are generated from my order flow software. But again, what I'm showing you today can be applied to any other footprint chart, but you have to know what to look for, right? So and that's why I'm here to teach you what to look for. So you'll see how easily and quickly you can apply order flow analysis to your trading. So, just a brief disclaimer, stocks don't always go up. We're in an unprecedented time where it just seems like, anything you buy goes up, although the last couple of days, everything you buy just goes down. But, over the last, literally almost the last year, we've been on this tremendous bull run in the market. So what is this about? Well, it's about order flow is about taking the different pieces of market information, right? Imagine the market's like a puzzle. You're trying to put the pieces together. And it's just like you pick up this piece. Oh, okay, I see it goes here. Then at the end of the day, hopefully you had a good day and you put the pieces of the puzzle all together during the trading day and you're able to come out ahead. So your normal bar chart, right? This is what most people look at when they come to the markets, right? Everyone's familiar with the normal bar chart, but have you ever thought about, for a second, where does that information come from, right? Where, why does the market stop here, and reverse up here? Most people don't really get to that point. They're just looking at this and see, well, yeah, the market opened at this price, closed at this price, had a high and a low here, but they never really think about how it's formed. Well, it comes from the time and sales, right? It's a record of every trade that occurs on the exchange as it occurs. Now, time and sales has a timestamp, okay? And it also tells you the price traded and the quantity traded at that particular time. But it also tells you what people don't realize is whether the trade was on the offer side or the bid side. And that's very important information, right? When I first started on electronic trading back in the early 90s, the Chicago Board of Trade, on their electronic trading system, they had this little ticker that would run at the bottom. And, most people, myself included, and everyone else on the desk was like, well, why do we need to see, what's going through? But it was really important because, on the trading floor, right, in the days of open outcry, you'd be able to see, which bank was buying or which big local was selling, and that was important information. And the Board of Trade was the only firm at that time that had that information available. So, you could see if there was a big offer, if Solomon Brothers was the offer, and if you're in the industry long enough, you know that who Solomon Brothers customer was, generally trading big size in the bonds and things like that. So that was important information. Nowadays, things are more anonymous in the sense that you don't know who the big players are, and the way execution algos are, they really break up an order into the smallest size possible, which is one lot. Now, this is just a screenshot of last night in the MNQ, right? The micro NASDAQ. And you could just see like every trade that goes through is like one lots, three lots, and it's really hard to get an understanding. But once you understand, well, did that one lot or this three lot trade on the bid, or did it trade on the offer? You could start to see, if traders are aggressive in the market. And all this information, right, is not, you're just not really looking at it on a bar chart. You're just looking at the price that traded. But when you take it and you put it on a footprint chart, you start to get more information than just the open, high, low, close, right? You're going to get information like the delta, which is the net difference between aggressive buyers and aggressive sellers, right? Remember earlier on the time and sales, right? You see different colors. You see orange colors, you see green colors. Well, if it's green and orange, it tells you, whether someone is lifting the offer or hitting the bid. And that's going to show up on the footprint chart, excuse me, as well as other information, right? As well as the point of control, which is the price level in the bar with the most volume. You're also going to see imbalances, areas where there was more aggressive buying than aggressive selling, or vice versa, more aggressive selling than aggressive buying. And all this information, delta, point of control, and imbalances, for the longest time was really all that people looked at in the order flow. And it's good information, right? Because imagine you have open, high, low, close, which everybody looks at. But if you can take it a little bit deeper, right? Delta, point of control, and imbalances, you're going to start to understand how the market is trading. Is it very aggressive, or is it less aggressive? Is the aggressive trading getting stronger in a direction, or is it getting weaker in that direction? If it's getting weaker in a direction, chances are that move is going to end. So there's all little things like that, right? So just really quick, the delta is the difference between aggressive buying and aggressive selling. How many people are buying the offer versus how many people are selling into the bid. Imbalances is when the aggressive buyers outnumber the aggressive sellers by 4-1 or more, and vice versa. Now, 4-1 is not set in stone. You can adjust that. Some people use 5-1, some people use 3-1. It really depends on your trading style. So you can see, right, already we're starting to look at really what the aggressive traders are doing. Are aggressive traders buying or selling? And, a lot of people, they think that, well, for every, in the old days, right, you'd call your broker, market's down 2%. What happened? Well, there's more sellers than buyers. Well, no, there's not more sellers than buyers. What you have is more aggressive sellers than aggressive buyers, right? Because obviously for every buyer, there has to be a seller. But when you have more aggressive sellers hitting the bid, taking out whatever's bid there, then hitting the next bid, taking that out, hitting the next bid, more aggressive sellers than buyers to cause the buying to go back up. Now, point of control is simply the price level in the bar with the most volume. Okay, and that's important because oftentimes, depending on where the most volume occurs in a bar, it can be very revealing in terms of market structure. Did the market stop at this level or something else happened? Okay, so, all these little pieces, they start working together and give you a lot of information. But knowing what the delta, point of control, and imbalances are is one thing. You have to know how and when to apply them to the market. It reminds me of back in high school, right? Algebra, right? We're all sitting there in our algebra class, our trigonometry class. When am I ever going to use this information, right? And all these little pieces of information, like delta, point of control, and imbalances. We know what they are, but a lot of traders just don't know how to put the pieces together. Okay, so this was again yesterday in the MNQ, right? You'll notice point A, market sold off and then rallied from there. Point B, market sold off, rallied from there. Point C, market rallied and then sold off from there, right? You ever thought about how these levels form? A lot of people like to come up with, well, this is a fib number, or there's a trend line you can draw in from here. You can literally draw lines from everywhere. I've seen people post charts online, on Facebook groups and things like that. And they literally got lines like every 5 points. And it's just like, then it hits that level. Oh yeah, see, I called it. Well, yeah, you got every 5 points, you got a line. But when you're watching the market trading in real time and you can start to understand what's happening in the market, it just really starts to make sense. So let's break it down. Okay, so point A, right? This is that first area right here where we came down. What was that, about 12.15 yesterday in the micro NASDAQ, right? 12.875. And then we reversed and started rallying back up. Well, as you can see, what's happening, right? Just on a delta basis, right? The bar before it, right? Big down candle, down red candle, right? Big negative delta, minus 421. Then this next bar opens up. Again, it's opened up and it's a big red bar down, right? It's got a very strong negative delta, minus 405 in the min delta. And that's telling you that aggressive sellers were in control. But what happened? Market reversed, closed higher, and you went from minus 405 negative delta to plus 58. Now, plus 58 isn't the strongest delta number to land on, but what did you have? Early on in that bar, it was very strong negative, minus 405. Everyone was thinking, oh, this is it. We're going lower. We hit 875. Next stop, 800, right? But it reversed. So it went from minus 405 all the way up to zero, then plus 58 where it closed. Actually went up to plus 71, which is the max delta. Then we closed at plus 58. So it went from minus 405, ate all that back, gave back 405 aggressive sellers, and took on another 71. So that's a big swing, right? So what was happening in this bar was very early on, the impression was that we were going lower, right? And honestly, it looked like we were going lower. But no, buyers stepped in, aggressive buyers stepped in and said, no, we're stopping it at this level. And market reversed, closed higher. Market took off, right? It went back up, went all the way back up from 875 all the way up to 930, and then it sold off again. Okay, this time it didn't get down to 875. It just got down to around 887 or 886 and a half here. And then it reversed and it went back up again. Now, what's happening this time around? Okay, it's slightly different. Okay, we're coming in, hot and heavy, right? It's got very strong negative delta, minus 300, minus 533, but then minus 127. Then it turns positive, 160. Okay, so delta is decreasing, minus 500, right? Minus 127, right? And then it's positive. Okay, well, how do you expect to go lower if we got positive delta, right? Well, chances are we're probably not going to go lower if there's aggressive buying happening, okay? And then the next bar confirms it with a big, strong positive delta plus 719, right? And then we rallied from, this 890, 900 area all the way back up to 950, came off a little bit, started going sideways, then came back up, poked a little bit higher here at point C, and then we sold off basically for the rest of the day, right? We sold off from, the 940, 950 area all the way down, 150 points basically. But let's take a look at point C. What's happening here? Well, we're coming back up. This is that point C high right here. Okay, this big red bar with positive delta. Okay, but you're thinking, we got positive delta. Why isn't the market going higher? Right? You're thinking, well, Mike, you just said, we can't go lower on positive delta, but here we are going higher on positive delta. Well, you sort of have to split this bar in two here, right? Because what's happening in this bar? Well, up here you've got some buying imbalances, right? You got 19 against 83. It's a little hard to see on this chart because NASDAQ trades such big, you sort of have to scrunch it a little bit. You see 7 against 21, or sorry, 3 against 21. So you got some buying imbalances up here in this red bar. Okay, so, market is rallying up. People are thinking, oh, this is it. We're going higher. We're going back up. The market's safe. Stocks only go up. And so they're all piling in here, right? But what you have happening up here is you have supply in the market, right? You have these big institutional players that have a lot of supply on the books. They're happy to sell it here at 850, or sorry, at 950, right? That's why you have these imbalances, because they're stacking the order book. They're working their offers up here, right? They're providing liquidity into the market that buyers are just happy to gobble up. Once these buyers gobble this up and they realize, uh-oh, we're not going any higher, it leaves these imbalances in here, these buying imbalances. Market starts drifting lower. These people that were buying up here at 949, 948 and a half realize, oh no, oh no, oh no, 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 no. The market starts selling down, right? It starts coming off. We're trading 44, 42, 40. They're long from up here at 50, right? So I got to get out now, right? So they start covering it down here. Bar closes lower, right? You're still left with that positive delta because you had that very strong buying early, right? And then the market starts trading down, down, down. Obviously, there's things here in the order flow. There's these what we call exhaustion prints here at the top of these bars, meaning this move is done. Stick a fork in it. It's going to happen. It's just going to fall over. This is a very bearish point of control right here. That's why it's colored red. But really, the sign was in this bar. You have this big, strong positive delta. At one point, it was 252. But you look at this bar, right? This is the thing, right? Where it gets kind of misleading for people, right? They're thinking, well, I got a positive delta. Why isn't this market going up? But then when you look at it, you say, oh, now I understand why the market didn't go up, because I had people, the market just put in a rally. We just took out our earlier high at 948, right? We popped back up here above 950. Oh, that's it. We're breaking out. We're going higher. Well, no, these people are trapped. They're caught off sides in the market. Then the market sells off. I didn't expect it to sell off to new lows, and the rest of the day expected it to come off, at least 20 to 30 points. But nevertheless, that was the clue that the market gave you, and you could see it as it's happening, as it's unfolding right before your eyes. Now, this was crude oil yesterday, right? Crude oil, we hit this high and sold off, right? Well, what's so special about this high? Well, anytime you're up at the high of the day, you got to be asking, why are we here? What's going on? But if you're looking at what's happening in the delta, you're at your high of the day, and all of a sudden you're seeing selling come in, right? Negative delta 138, negative delta 165, then a small delta 11, 33, 25, more selling, right? Here, big negative delta at minus 264, right? And that's all coming in right in here, as you're at the high. Do you think this market's going to go higher if you see the aggressive selling come in? No, then we sold off about 50 cents, right? Market eventually came back up, to this high a little bit later, about 130. But, really what was happening here, right? You could see the selling coming in, right? All right in here, right? In the negative deltas, minus 138, minus 165, minus 264. You could safely say, well, you know what, if it starts to break down, just, around here, I could get short, right? Because, what's my risk? My risk is up here at the high, or even lower, a little bit off that high. But as you hit that high, what happened? You attracted sellers into the market. Right, then you can just see, right, the market sold off. It sold off all the way down to the 60 area, and it came in here, right? This was sort of that lowish area. But if you're looking at the volume, right, you can see that big, heavy volume going through. This is more of an advanced concept, right? You can see the point of control down here, but you can see this volume, right? 115, 132, 126. Even earlier, as we're coming down, we're running into some liquidity to support this market. 161, 148, 143, 162, and then in this bar, 115, 132, right? You have this area here where the market goes back up, comes back down into this area between 68 and and what is that, 58. This 10-cent range is your support, right? We came back into that level. Then the market went back up again, made a new high by a tick, one tick, new high. Sometimes people get excited. We're starting going back up to the high of the day. Okay, thinking this is it. We're going to break out, go higher. What happens? Nothing. One tick high, and then the aggressive selling reappears, right? We're up here at the high of the day, just made a new high. But what do you have? Aggressive selling, minus 144, minus 136, minus 350. Okay, not exactly the most encouraging thing as a trader, to see at the high of the day is aggressive selling in the sense that if you're at the high of the day thinking the market's going higher, you do not want to see aggressive selling creeping into the market at strong levels. And the thing is, you just use your brain to see, well, yeah, okay, is this a strong minus 144 negative delta? Yeah, considering that the previous bar was 128, the previous bar was 36, the previous bar is 132, as you're at the high. So what you have here is you got negative delta that's stronger than any of these previous deltas. You got to go way back here, 10 minutes earlier to find any delta that's a little bit stronger. But what you have in now is you got the aggressive sellers coming into the market thinking, you know what, this is a great opportunity to get short. Okay. E-minis yesterday. All right. Market sold off, rallied back up, and just sort of hung around here. Right. Then we sold off another 10 points, rallied back up, took out that high, then sold off. But what was so special about this, right? This was a quick move down right here. You can see these bars, 1, 2, 3, 4 bars where it just dropped 10 points. I mean, it's just sort of rallied up here, sort of did nothing, went sideways, and then dropped, right? Then rallied back up. Well, what you had earlier at that level, at around the 14 level, is what's called a stacked imbalance, right? Where you have aggressive sellers, right? What's an imbalance, right? An imbalance is where you have more aggressive sellers than aggressive buyers, if it's a stack selling imbalance, by a ratio of 3 to 1. But that's just an imbalance. But when you have a stacked imbalance, that means you have 3 imbalances stacked neatly on top of each other. And you can see it right in here, right? This 584 against 75, 103 against 0, 456 against 2, right? So you got 3 imbalances all stacked neatly on each other. I mean, a lot of times you have bars that have imbalances, and oftentimes you can see they're spread out right here, these buying imbalances, right? Here's 3 imbalances, but they're not stacked on each other. Here's just 2 imbalances stacked on top of each other. It's just 1. But when you have 3, it gives it, I don't say it gives it more weight, but, that's sort of the area where, things get interesting in terms of order flows, because what's happening, right? When you have 3 levels or more, I mean, it could be 4, it could be 5. But what you have is oftentimes you have a quick move, right? Somebody's wanted, there's a big order going through the market for whatever reason that they want to fill, right? And it leaves what's called a stacked imbalance. And oftentimes you see the markets, come back and test those levels, right? Because if you had aggressive sellers at one point, well, chances are if we get back to that area, you want to know if those aggressive sellers are coming back into the market. And what happened is it rallied, sold off, rallied all the way back up to that level, and then sold off again, right? Sold off 10 points. So, you can see how order flow can help you as a trader. But, a lot of people, they think, oh, you know what, that's great, but it's too complicated. I'll never remember how to do it all. So what I want to show you today is to make it as simple as possible, right? I want you to focus on one thing, right? Bars with multiple imbalances that are not neatly stacked on top of each other. Now, I just talked about a stacked imbalance, right? Where you had, right, 3 imbalances stacked neatly on top of each other. But what if it's not stacked neatly on top of each other? What if you have a bar with 3 imbalances, but they're spread out, right, in a bar? Well, does that mean they're not important because they're not stacked on top of each other? Well, no. I mean, they're still important, if not more important, right? Because one, everybody is looking for stacked imbalances. Everybody knows what stacked imbalances are that uses order flow. I mean, that's one of the basic trade setups that people look for, stacked imbalances. But what people don't look for some reason, I don't get it myself, they don't look for those bars that have multiple buying imbalances that are spread out, right? They may not be stacked neatly on top of each other. Like here's 1, right? 2 against 237, 5 against 203, 19 against 98. They're not stacked neatly on top of each other. They're spread out. But what you have is you have aggressive buying being spread out throughout the bar, right? Causing imbalances in the bar. And that's important because people, for some, they're just not looking for that. But you have that aggressive buying in the bar. Now, This is E-minis yesterday, right? Right. Remember, we opened up, cash opened here on the 14 level, rallied all the way up to 24, sold off back down to, the 10, 11 level. But why? Why does it reverse here? Why does it reverse here? Well, if you're looking at a footprint chart, you would understand why, right? You can see these imbalances in here, right? The bottom of this candle, 182 against 40, 172 against 13. 155 against 2, 198 against 7, 59 against 2, right? Even this other bar here, you got 1, 2, 3, 4 imbalances. 2 are stacked here, then you, sorry, 5. 1 here, 1 here, 1 here, 2 here. Even this next bar, 1, 2, 3, 4, 5. These are spread out also, right? But what if there was a way to say, to highlight to you that, hey, you got these multiple imbalances, pay attention to what's happening in the market, right? And that's, when I created my software, that was one of the things I wanted to have in there. It's like, you know what, I'm watching so many different markets, and when one market's moving, chances are some of the other markets are moving, and it might be not to say difficult, but it might be hard to notice some of these little things. So I said, why don't we put a signal on the chart to tell me, hey, you know what, you've got imbalances happening here, multiple imbalances in a bar, right? So what we do is we put a box around it, right, to highlight that to you. Just, because we're visual. We are so used nowadays to Facebook and Instagram, just, scrolling through our timeline, so to speak, and seeing, images and reacting to those images, right? The mind processes images at a much faster rate than numbers. Okay, so I'm not necessarily concerned about what the numbers are in the bar, in the footprint. I'm concerned, are there imbalances, right? And I can see 1, 2, 3 bars here out of the 4 that have multiple selling imbalances. Okay, that's my clue that, hey, you know what? Up here, I got aggressive selling coming in, right? I can get short, right? Just by seeing that, all right? Just by seeing, something so simple, right? Then what happened? The market sold off. We hit this area down here around 10. Now, this is a prominent point of control. I'm not going to talk about prominent point of controls today because that's a whole nother training session, but I've got a lot of videos on YouTube talking about prominent point of controls. But what do you have in this bar? Right, you've got 1, 2, 3, 4, 5, 6 imbalances. Now they're not stacked on top of each other, right? You got a space in here, you got 2 price levels here. These 2 are stacked on top of each other. And then another 2 normal order flow volume levels going through, then another 2 imbalances. And if you're just looking for stacked buying imbalances, you're going to miss this, right? You're not going to see this bar, which is very bullish, right? But if you have something that can highlight it to you, something so simple, right? Again, it's not, some fancy black box mathematical equation that you're not going to understand. You understand the idea of imbalances, right? You understand the idea of stacked imbalances. What this is just, it's imbalances in a bar that are not stacked neatly on top of each other over a certain level, right? Over 3 to 1. You could adjust it if you want to have bars with 4 imbalances that are not stacked on top of each other, or 5, or even 2, right? Depending on the type of chart you're trading. Say you're trading a really fast chart, a 233 tick chart, maybe you want to use 2 levels of imbalances. So, there's a lot of flexibility with it. But again, if you're not looking for it, you're not going to see it. Right? So remember, the information you see on your bar chart comes from what's traded in the market, right? From what you see in the time and sales. But a candlestick chart leaves out the most important part of that data, is the volume that's traded on the bid, the volume that's traded on the offer, but more importantly, how it traded. Was it aggressive? Was it your just normal order flow, right? Markets exist to facilitate trade, right? Markets exist for people to transfer risk from one party to another. Again, yesterday in the E-minis, right? We come up here, we just sort of go sideways, then we start falling apart here around this 24, 25 level, right? And we sell all the way down to 04, 05, right? Rally, put a half-hearted rally back up, sell off again, and rally back up. And if you remember, this was that area where it sold off in here, right? This was that stacked selling imbalance here, okay? That's all well and good, But would you rather be short from, the 13, 14 area, or would you rather be short from 26, 25, 24, right? When we sell all the way down to 04, that's an extra 10 points that, if you're looking at just stacked imbalances, you're not going to pick it up, right? And what do you have here, right? This is that area right in here, in this circle, right up here. This is this red bar, right? And what makes this red bar so special than this one or this one or this one or this one? Well, it's got the multiple selling imbalances: 777 against 31, 39 against 7, 191 against 39. And then 2 bars later, another 3 selling imbalances that are not stacked on top of each other, right? So you're going to miss it if you're only looking for stacked selling imbalances, right? Then the market sold off, right? We sold off again. That's from this first bar is happening around the 25 area, 25, 26. Then this next bar, 20, what is that? 21 to 24. Okay. Say you miss it up here and you catch it here. Okay. You're getting short from 21, 20 worst case, all the way down to 04. Then you come down to 04, right? Your market's selling off. You're still seeing selling imbalances, bars with multiple selling imbalances. That's what you expect to see in a market selling off. But then it hits this area, comes in, boom, goes sideways, 1, 2, 3 bars. But in this third bar, what do you have? Multiple buying imbalances, right? You got 1, 2, 3, 4, 5 buying imbalances, right? Then the next bar, 1, 2, 3 buying imbalances. Now, none of these are stacked buying imbalances of 3 or more. So if you're looking, again, just for stacked buying imbalances, you're going to miss this, right? You're going to miss this. So you're going to miss that move right here, back from 08 all the way back up to, 16, right? So you're going to miss this move down, miss this move up, right? Now, I'm not saying, you'd sell up here and cover it down here. You'd sell it here, probably cover somewhere down in here. Then you see this multiple buying imbalances. You get it here, you can cover up here. Right? I'm not saying you'd buy at the low, sell at the high, but there's chunks of market activity that you can get. So, just fair warning, don't just go out and start trading every bar that has multiple imbalances in them. Put them in context of the market, right? Always trade in context of the market. That's what being a trader is. It's not just about red light, green light systems. You want to be looking for a reason to sell when we're at our high. Don't come in thinking, I got to sell at a high. If the market tells you, there's aggressive selling coming in at this high, okay, that's great information. Or if you're at a low or the low of the day, swing low, whatever, but the market is showing you that, hey, you know what? The aggressive buyers are coming in. You got a lot of buying imbalances coming in here, telling you traders are scooping up this, these low prices. Take advantage of it. That's what putting it in context of the market is. Just don't go out blindly trade every bar that has multiple imbalances. Crude oil, right? What's going on down here, right? We're just, we sell off, boom. Then we just sort of go sideways in here. Then we rally $1 yesterday. Right? All these charts are from yesterday. Well, as we sold off here, right? All of a sudden, 1, 2, 3, 4 bars with multiple buying imbalances. None of these are stacked imbalances, right? They're all spread out in the bar. So, if you think that, stacked imbalances are the way to go, I'm thinking take it a step further, look outside the box, look for those bars with multiple buying imbalances. Now, again, you don't have to have my software to see this. You can look at the chart with your own eyes, but having software that's going to highlight it to you just makes it that much easier. When traders first learn about order flow, they learn what delta, what point of control is, what imbalances are, but then they're sort of left to figure out on their own how to use those pieces of information. Again, what's the point of having information if you don't know how to use it, right? This was crude oil this morning, 7:45, boom. We had a couple bars here. We came into a swing low. Aggressive buyers started coming in. E-minis this morning, 3:50 in the morning, we had a 10-point sell-off from 94 down to 84. Why? Multiple imbalances, right? What makes this red bar different from these is this is the bar with the multiple imbalances. These didn't have anything. Even these green bars, nothing special, no multiple buying imbalances. So what I just showed you can be done by looking at any footprint chart, but you need to know what to look for and when to look for it. Honestly, when the market's moving, especially like yesterday, even today, right? When the market's down hard, it's easy to overlook things and miss things. Let your trading software do some of that heavy lifting and show you things in the market like market weakness or market strength, right? Signs of aggressive buying is market strength, right? Order flow is about taking the information that you see, that you have access to, and putting it into an easy read format. So, in this past 40 minutes, hopefully you agree it's time well spent, but you can't cover everything in, a 40-minute or 60-minute training session. But I got a special offer for you so you can get up to speed and learn everything you need to know about order flow as quickly as possible. All right. Order flow is a great way to trade the market. Now, the Orderflows Trader software, right? The software I developed, it runs on NinjaTrader 8. It doesn't run on Sierra Chart. It doesn't run on TradeStation. It runs on NinjaTrader 8 because it's a very easy and stable program to trade with. And it's a volume footprint chart with 17 pre-programmed tools, right? I just talked about multiple imbalances, so there's another 16 tools on there for you. It takes 2 minutes to set up, right? You don't need fancy templates or anything like that. It really just plug in, import, you put NinjaTrader on, put the Orderflow Trader software on, and you're basically set. Normally I sell this for $8.99 on my website by itself. Just the software itself is $8.99. But it's really like the software, the best way to describe it is like taking everything from my brain that I've learned, in 25 years of institutional trading and putting it into a program to help you dissect and understand what's happening at the market. If you're looking for a red light, green light system, this is not for you. This is for people that want to understand what's happening in the market. But having software is one thing. Need to know how to use it, right? I mean, I've bought software in the past, all sorts of different softwares, and I don't know how to use it. I just give up, right? So I provide you a lot of extra education to get you up to speed on not just how to use the software, but order flow in general. So I give you access to my order flow trading course, and you can get it for free. You could buy it on my website for $297, but I'm going to give it to you for free. I'll also give you access to my Inner Circle video series, right? There's 56 videos in there of advanced order flow tips and analysis and tricks, different ways to read the information that is presented to you in the order flow. So you start adding all that up, and it starts. People say, "Oh my gosh, it's $16.93," but you're not going to pay that today, right? And the other thing that I want you to realize, right? It's one thing to learn from videos, but it helps to have some sort of hand-holding live training available to you. So every Tuesday night, and I've been doing this for over 2 years, probably close to 2.5 years, I do a live training session every Tuesday from 7 until 8 p.m. on Tuesday night Central Time. And I talk about things I saw in the market and, about order flow in general, right? And if you want to come in, you got to ask me a question about something. I'm there for you, right? It's your time to spend with me. We can, I talk about all sorts of things, time for you to ask questions, things you're stuck on. And if you can't attend, there's an archive that you could go to. Some people charge extra for this, right? I mean, what's the point of buying software than having to pay extra for training, right? That should be included in there. So, you start adding it all up and it's close to $2,000, but you're not going to pay that. You're just going to pay $749 today, right? It's a one-time payment. It's not a recurring payment that you can't cancel or anything like that. It's just $749. Of course, you'll still need to pay your data fees. So, a lot of people say very nice things about the software. It helps them understand the market. So what you do is you go to orderflows.com/oft3 and you scroll down to the bottom of the page and it takes you here. You just click that button to get started. It takes you to PayPal. PayPal processes your payment. And again, to get started, go to orderflows.com. So you got to figure out what motivates you in life. What do you want to be, right? For me, freedom, right? Be able to do what I want to do when I want to do it. That's what trading provides me. Now, as a special bonus for Investors Expo, I'll give you access also to my order flow playbook, right? It's an additional training. You're going to get it for free, right? So go to orderflows.com/oft3. You're going to get all this here, the Orderflows Trader software, the trading course, Inner Circle video series, live weekly group training, and you're going to get the order flow playbook. So to get my book, go to orderflows.com/book.html. Takes you here. Enter your name and email, hit submit, takes you to the download page. So again, to get started, go to orderflows.com/OFT3. Anna's already put it into the chat, but I'll also put it in there along with the link for the book. And, I'm right tight on time, so I'll throw it back to you, Anna. If anybody's got any questions, just shoot me an email. It's just mike@orderflows.com. It's my email. But thanks, Anna. I'll give it back to you so you get the next speaker on.
Thank you so much, Michael. Great presentation.
Thank you.
Let's move on and bring to the show our next guest,
Muted.
Steven Koitzel. Hello, Steven.
Hey, can you hear me?
Yes, the sound is good. The screen looks